Happy Friday, Eric Bible with the Bible team at Neo Home Loans, and talk about an abrupt change in the overall tone and strength of the United States economy in such a short period of time. With that, we've seen a significant reversal in mortgage rates, and really it's brought into question around, can the Fed achieve this infamous or elusive, if you want to call it, soft landing? So we'll start mortgage rates. As we kick off the day, the 30-year fix is sitting at 6.63%, which is, yes, slightly up from last week, 6.61. But there's a key element within there that at one point this week, we saw the 30-year fix dancing with 6.3%. And it's really around this component around, is the economy as strong as we initially thought, and what the Fed does from here. So let's dive into this. What drove rates to do what they've done, where we see that going from here, and we'll close with what the Fed's play with this information and how we can deliver this message to our consumers. What actions we can take right now to help drive activity. So mortgage rates. As we reported last week, the Friday market opened with a surprise in the jobs report, which put a tremendous amount of pressure on stocks and mortgage rates. And as I mentioned earlier, the 30-year fix, at one point through this evolution of events, we saw right around 6.3, which is arguably, no doubt, best rates we've seen all of 2024 and some of the best rates we've seen in over a year. Now, they have, again, moderated from those levels, but it appears we've hit this new range where we're going to continue to see volatility, yes, but rates want to go lower. And it's centered around the fact that the Fed has kept the Fed funds rate at an elevated space, which has created a slowdown within the overall economic landscape. Yes, inflation is moderated, and we'll get to see, more, hopefully, moderation next week in the CPI release. But in turn, that's put a tremendous amount of pressure, the actions from the Fed, on the labor market. And last week's surprise in the BLS, Bureau of Labor and Statistics jobs report, where we saw unemployment go from 4.1 to 4.3, is really what sparked this new rally. And we again saw the rot on Wall Street and mortgage rates rally. And keep in mind, the Fed has not yet done anything other than talk. We've remained at this elevated space in monetary policy since their last hike. Fed has done nothing. So again, it's further confirmation that one, Fed does not control mortgage rates. They do not control mortgage bonds. It's appearing to be the opposite. Mortgage-backed securities, the overall market controls the Fed's behavior. So here with this surprise in unemployment and how the market has responded to what we anticipate the Fed to do, it appears that mortgage rates are finally on the rebound, which in turn creates ample opportunity for our clients now and our clients in the future. So what we expect to see the Fed do from this recent kind of pivot within the overall labor market. September is the next meeting. And where Jerome Powell last week specifically laid out, yes, it appears that our next move will be a rate cut. Up until Friday, the expectation was 25 basis points. With unemployment doing what it's done, now the consensus is, okay, will it be 50 basis points? Could it be more? Will we see another cut in November? Will we see one in December? So yes, I don't want to get too in front of ourselves, nor does the market, but it does appear that the next move from the Fed will be a minimum of a 50 basis point rate cut. And given the fact that the market interest rates from a mortgage perspective has responded in this manner, the expectation going forward is that we will continue to see improvement in mortgage rates. Now, with that, the Fed is undoubtedly in a tough spot that we don't want to see an emergency cut or anything along those lines, because it could create more fear, which fear creates additional volatility. So here, the message we need to continue to deliver to our consumers is that rates are finally on the rebound. And yes, home values have continued to bode exceptionally well through this cycle. We know that there are a ton of consumers, both sellers and buyers, that are waiting for this exact moment, that they did not want to enter market until rates were in a more affordable space. My fear is that as rates continue to fall, inventory levels are going to remain at these, current levels that we're seeing, which in turn is going to create price pressure. So the message we need to continue to deliver is an appropriate time to take action is now. We can absolutely refinance the debt as things further correct. Buyers that purchased in October, November, December of last year are already feeling the benefit of buying at a higher rate and refinancing into a lower rate today. So that's the message we need to bring out to our consumers. As always, if you run into challenges with conveying this message, know that we're here to help. As always, make it a fabulous Friday and an even greater weekend. Thank you.